Now, when it came to Tim and Rochelle, they wanted an Airbnb cash flow based investment, but at the same time, they also wanted an asset that had the ability to accumulate in value as well. So they wanted the best of both. They wanted capital growth and they wanted cash flow as well. So the combination of the two will allow them to continue to build a property portfolio as the cash flow coming in doesn't hurt their serviceability, and obviously the capital growth piece allows them to rinse and repeat, pull the equity out, purchase consecutive properties and go again. So in order for us to go out to the marketplace and target what we believe to be the best performing assets in the marketplace, we have a very stringent and rigorous selection criteria. And when it came to selecting this particular apartment for our clients, there were three critical things that we didn't shy away from. The first one was that we wanted to ensure that we bought an apartment that has owner-occupier appeal. So it is the owner-occupiers that drive a marketplace. They make up a large portion of the transaction volume, on average roughly around 70% across the marketplace. So when you have an asset that appeals to this owner-occupier base, it gives you a good market depth there, just in case their situations change and they may have to liquidate the asset in future. We do know that there is owner-occupier or pent-up owner-occupier, the demand there, that gives them a nice exit strategy. But in addition to having the owner-occupier appeal to create market depth, it is the owner-occupiers that also are the ones that get emotionally attached to property. They get emotionally attached and they end up overpaying. And these are the type of people you want to appeal to because they drive a marketplace and they in turn create the necessary capital growth needed in the marketplace for you to grow your wealth. So it is these owner-occupiers you want to target, and it's important that we targeted these owner-occupier apartments that have appeal to that particular segment of the market. So that's number one, and that's extremely important. I couldn't stress it enough. Number two, what we did was making sure that we targeted an asset that we believe was scarce. It's in short supply. There's a finite amount of it. The apartments on average and across most marketplaces in Australia have a tendency to be in overabundance. So that means that there is a lot of them. So in that instance, you want to ensure that you're not picking something that looks like everything else or is like everything else in the marketplace. You want something that's unique and that's scarce and where there's only a finite amount of it. So we generally target what we believe to be our small boutique residential blocks where there is, on average between a maximum 40 boutique residents as opposed to 400 in a particular unit block or complexes. So it is those that we target because of that scarcity factor. And the last piece, and it sort of complements that scarcity piece, is that the property and that type of investment that is scarce gives it a nice healthy land to asset ratio. When you have 400 apartments versus 40 apartments on one big block of land, then your land to asset ratio gets skewed in the favor of the house as opposed to the land when you have the best part of 400 of them versus only 40 of them. You have a nice healthier land to asset ratio. So if you can stick to those three things like we did for Tim and Rochelle, you're going to certainly put yourself in the upper echelon of the properties in the marketplace that just may outperform. Thank you guys, and bye for now.